You just bought a stock at $50.05 and immediately sold it, without the price moving a single tick, and you're already down $10. No commission charged, no fee line on your confirmation, just $10 gone. That's the bid-ask spread, and it silently taxes every single trade you ever make. Every quoted stock price is actually two prices living side by side. The ask is what you pay to buy, the seller's minimum. The bid is what you receive when you sell, the buyer's maximum. Right now, on that $50 stock, those two numbers are $50.05 and $49.95. The gap between them, 10 cents, is the spread. The moment you buy at the ask and sell at the bid, that 10-cent gap is gone from your pocket. It doesn't matter that the stock never moved. The spread is the price of entry and exit, baked directly into the execution prices. Every round trip pays it, guaranteed, before any profit or loss from price movement even enters the picture. Now here's what makes the spread so insidious. Your brokerage confirmation will never label it. Brokers have spent years advertising zero commission trading, and technically that's true. There's no explicit fee row, but watch what actually happens. You buy 200 shares of a thinly traded stock. The midpoint, the fair mathematical center between bid and ask, is $15.05, but you're buying at the ask, which is $15.12. That's 7 cents per share above mid. 200 shares times 7 cents is $14 in spread cost, paid the instant the trade executes. Your confirmation shows the fill price of $15.12 and a commission of $0. The $14 spread cost is completely invisible. It's just embedded in the price you paid. Zero commission doesn't mean zero cost. It means the cost moved somewhere you can't see. The spread isn't random. It's tightly linked to how actively a stock trades. Liquidity is the key variable. Apple trades hundreds of millions of shares a day, and the competition among market makers to capture that flow pushes the spread down to a single penny. Bid $189.99, ask $190, a spread of 1 cent, which is roughly 0.05% of the price. Almost nothing. Now look at a small cap biotech with thin daily volume. Bid $480, ask $520. That's a 40-cent spread on a $5 stock. Do the math. 40 cents divided by the mid price of $5 is 8%. One trade in, one trade out, and 8% of your capital has already been consumed by the spread before the stock moves at all. The same dollar amount invested in Apple versus that biotech faces a spread cost 1,600 times larger in percentage terms. If one spread is a small annoyance, what happens when you trade frequently? Each round trip, a buy followed by a sell, pays the spread twice in economic terms, once on entry, once on exit. The cost isn't additive the way most people imagine. It compounds across every position you open. Think of it as a break-even tax. Before a trade can profit, the asset must first appreciate enough to cover the spread percentage. 50 round-trip trades per year at an average spread cost of 0.10% per round trip produces a cumulative drag of 5% on every dollar deployed that year. That 5% must be earned back before a single cent of net profit materializes. For active traders running dozens of positions simultaneously, this compounding spread drag quietly rivals or exceeds the actual edge they're trying to capture. As the number of trades grows, the drag doesn't stay flat. It scales linearly with every position. A trader running 20 trades a year at that same 0.10% spread faces a 1% hurdle. 50 trades, 5%. 100 trades, 10%. Most active retail strategies don't generate 10% alpha consistently. The spread doesn't care about your thesis. It collects the same percentage whether the trade wins or loses. Understanding this curve changes how you evaluate trading frequency entirely. The question stops being, how often should I trade? And becomes, does my expected edge per trade actually exceed the spread cost? So who is on the other side of this transaction, collecting what you're paying? Market makers. These are professional firms, often running sophisticated algorithms, whose entire business model is built on posting both a bid and an ask simultaneously, and profiting from the gap between them. The mechanism works like this in precise terms. A retail seller hits the bid of $9.98 and unloads 500 shares. Minutes later, a retail buyer lifts the ask of $10.02 and buys those same 500 shares. The market maker bought at $9.98 and sold at $10.02, a 4-cent spread on each of those 500 shares. That's $20 of risk-free profit on a single matched pair of retail orders. The market maker took no directional bet on where the stock was headed. The spread alone was the entire business. This happens millions of times per day across all markets. Market makers' profit on any single pair of matched orders is straightforward. Ask minus bid multiplied by shares. On that 10.02,998 quote, that's 4 cents per share. But 4 cents per share, matched continuously across thousands of stocks and millions of shares per day, generates an enormous and extremely reliable revenue stream. The market maker is essentially running a toll booth on every trade. Retail investors on both sides, the seller and the buyer, each pay half the spread in opportunity cost. Neither one realizes they're funding the same intermediary. The spread is the mechanism by which liquidity providers are compensated for standing ready to trade, but from the retail investor's perspective, it is a pure transfer of wealth out of their account. Options take this problem and amplify it dramatically. If a 1 cent spread on Apple stock is nearly invisible, option spreads are anything but. Consider a call option with a mid-price of $1.20, perfectly reasonable for a near-the-money contract on an average liquidity underlying. The bid is $1.10, the ask is $1.30. That 20-cent spread sounds small in dollar terms, but divide it by the $1.20 mid-price. You're paying a 16.7% spread cost the instant you buy that option. To break even, the option's value must increase by more than 16.7% just to offset the spread you paid on entry. The underlying stock must move, and move in your direction fast enough to generate that gain on the option. Most retail options trades don't survive long enough to overcome that structural headwind. Compare the spread burden across asset types side by side and the picture sharpens fast. A large cap stock like Apple carries roughly 0.005% in spread cost. A small cap stock might run 1/5%. A liquid index option might be 1/3% of the premium. A retail equity option on an average underlying, commonly 10/15%. Each step up in that ladder represents a proportionally larger break-even return required before any profit is possible. A retail trader switching from stocks to options isn't just changing their risk profile. They're increasing their spread tax by 1 to 3 orders of magnitude, often without realizing it. So the spread is unavoidable, but is it always inevitable at its full width? Not quite. The key insight is that market orders and limit orders interact with the spread in fundamentally different ways. A market order says, fill me now at whatever price the market offers, which means you buy at the ask and sell at the bid, paying the full spread every time. A limit order at the midpoint says, I'll only transact at the fair center price. If that order fills, you've saved half the spread on each side of the trade. On 1,000 shares with a 2-cent spread, placing a limit at the mid-price of $10 instead of hitting the ask at $10.02 saves $20. But there's a real trade-off. If the price moves away before a counterparty meets you at the mid, the order doesn't fill. You save the spread cost but miss the trade entirely. The checklist for minimizing spread costs is short but powerful. Use limit orders near the mid-price rather than market orders. That single habit captures roughly half the spread on every trade. Concentrate trading in the most liquid instruments you can, because liquidity is the only force that durably compresses spreads. Reduce trading frequency wherever your strategy allows, because every round trip is another toll paid. And treat the spread as a real cost in your return calculations, even when your brokerage confirmation refuses to label it as one. None of these steps eliminates the spread entirely. Some gap will always exist between what buyers pay and what sellers receive. But the difference between an investor who accounts for spread costs and one who ignores them can be several percentage points of annual return, compounding silently over years. Step back and look at the full picture. Every time you trade, 2 prices exist and you always get the worse one. Paying the ask to buy, receiving the bid to sell. The difference vanishes into the market maker's pocket, invisible on your confirmation statement. In liquid large caps, it's nearly nothing. In options and thinly traded stocks, it can consume 5 to 16% of your position value in a single round trip. Traded frequently, that cost compounds into multi-percent annual drag that must be overcome before any profit counts. The spread isn't a quirk or a technicality. It's the foundational cost structure of every market you trade in. Understanding it doesn't just change how you read a quote. It changes how you evaluate whether a trade is worth making at all.